This is the first in a series of videos called the Financial Crisis Timeline. And this series of videos will talk about the events of the financial crisis, how they unfolded, and what they really mean. I think it's something that a lot of people are still confused about. I wanted to create something fairly comprehensive that would explain the whole thing. So there are going to be several parts to this video series. This is the first one, called The First Signs. Let's go all the way back to July of 2007. This was the first inkling of anything going wrong. Two hedge funds within Bear Stearns collapsed, and they collapsed virtually overnight, within a matter of days. They held a large number of subprime mortgages. Now, at first, investors thought that this was just an aberration. It was very specific to the specific funds within Bear Stearns. The general market didn't really have to worry about this too much. So the markets actually kept going up for several months afterwards. But by the beginning of 2008, investors realized, Citigroup had posted a little bit of a loss, and other banks were starting to write down some of these toxic assets. They realized this was something that was a little more serious. And it got exacerbated when, in January of 2008, Countrywide, which was a major mortgage lender and originator, was acquired by Bank of America for $4 billion. Now, $4 billion sounds like a lot of money, but Countrywide was actually worth a lot more before this. It was worth in the tens and tens of billions of dollars. So this was already a pretty dramatic fall. And the market started freaking out. Stock prices went down. And as a result, in February of 2008, $168 billion stimulus bill was signed and passed, and it was paid out in the form of tax rebates. So if you got a tax refund in the mail after April 15th of 2008, $300 or $600, that's what that was all about. It was supposed to get the economy going again. Anyhow, let's move on to March of 2008, which was one of the most pivotal initial months in starting this credit crisis. In March of 2008, a lot of stuff started focusing around Bear Stearns, which was declaring more and more losses. And what happened was a bank run started ensuing on Bear Stearns. What this means is investors started withdrawing money at a very, very rapid rate from the bank. So the bank's capital base, the amount of cash that it has on hand, financial resources that it has on hand to facilitate transactions, it went from $17 billion to $2 billion in a matter of days. That is a very, very scary thing for a bank. So now Bear Stearns didn't have enough money to meet its many obligations. As a result, Bear Stearns goes to the Federal Reserve for an emergency loan. On March 14th, it gets this loan. That was a Friday. And the Federal Reserve starts shopping Bear Stearns around to various buyers. 2 days later, on Sunday, March 16th, Bear Stearns was sold to JP Morgan Chase for $2 a share. Now, this price was later amended to $10 a share, but Bear Stearns had traded at more than $170 per share just 2 years earlier. So this was an enormous collapse. Lots of people lost their jobs. Lots of shareholders lost tons and tons of money. So the markets definitely reacted very strongly to this event. I'd like to pause here for a second and talk a little bit about executive responsibility in the context of Jimmy Cain's bridge game. Now, Jimmy Cain was the CEO of Bear Stearns. This was during the collapse, during the Federal Reserve loan, and during the sale of JP Morgan Chase. Now, while all these unprecedented events were going down, Jimmy Cain was playing a bridge tournament in Detroit. Now, nothing wrong with that. He's perfectly allowed to play bridge. But here's what was shocking, is that he actually left a conference call that was discussing these important events to continue playing his tournament. Taxpayer dollars are on the line. Shareholders' dollars are on the line. Employees' jobs are on the line. And his bridge tournament was the most important thing. So I'm telling you this because I think these CEOs need to be checked. We need to, as shareholders, we need to vote our shares actively to prevent people like this from coming back into power and abusing the system. So I have nothing wrong. There's nothing wrong with making money, but I think that Jimmy Cain was not responsible in this situation. Anyhow, let's go back to the summer of 2008, continue the series of events here. In April and May of 2008, the market started staging a modest recovery. Now, that was certainly a good thing. A lot of people attributed it to the Bush tax rebates, but the recovery was honestly short-lived because as the market started going back up, there was a really, really strong rise in oil prices. And this led to severe inflation. As a result, investors started getting very scared. To make matters worse, the financial system was not healing at all. In July of 2008, IndyMac Bank collapsed. IndyMac was a major mortgage originator. It actually used to be part of Countrywide. And this event drove the Dow Jones Industrial Average below 11,000 for the first time in almost 2.5 years. So this was kind of the buildup. You had expensive oil prices and commodities going up a lot. You had financials getting battered, real estate getting battered, and everything was kind of already a little bit icky. But the events of September 2008 took things through a whole nother level, and that's going to be the focus of the next video. Thank you very much for watching, and for similar videos, please check out www.canjo.com.